This is another episode of me sticking my nose into these charts every single day until I discover a trade model that makes me millions of dollars. And today, my trade model was present. So, let me open up the Notion database. Yesterday, I literally outlined this as the model that I look for because this is what I've been seeing through my observations. Here's my observations. I'll go through that in a little bit, but first, let's go over the model. So I outlined this yesterday. This is my bread and butter entry model, and it literally played out today, and it played out, did it play out yesterday? I think it played out yesterday too. But this is just what I see repeating over and over and over again. So this is what I'm looking for post 9:30. Post 9:30, I want to look for this, and this is what occurred today. So initially, the market reaches for primary buy-side liquidity first, and that is liquidity that a pool of liquidity that I can frame on the 15-minute time frame. It reaches for that first, right? And it leaves relative equal lows below the marketplace. And the market trades higher up into a higher time frame premium array and or liquidity. And that is when I see an indication that price is no longer capable of trading higher. And then I look for a sell signature and price action. And I saw exactly that today to the T, and it was beautiful. And I followed through with it, and it played out, and it makes me feel good because how long have I been studying ICT? For over 2 months now. I finally established a trade model, and I literally the day after I established it, I made this little drawing. I see it play out live in price action. I hypothetically executed on it, and it worked, and it was beautiful. So I want to see price trade into a higher time frame premium array and or liquidity, and I want to see a sell signature, which what I look for is first, I need to see a change in the state delivery or market structure shift. I need to see a sell side imbalance, an inverse fair value gap, and a breaker. And that all happened today. And price first takes the primary buy side liquidity, then it'll revert to the other side of the range, take the primary sell side. So my first target would be that first short-term low. There's my first partial. And then my second target would be the primary sell side liquidity outlined. And then my third target could be a new day opening gap and or a new week opening gap below that. And this is the time that I would like to see it occur. If I see it develop within the 950 to 1010 macro, that is an A++ sell scenario. That is beautiful. That's everything that I need to see. Now, in today's price action, it occurred a bit later, but that's okay. I mean, not a bit later, a bit earlier, but that's fine. So if I outline this, where is it? There it is. Let me open this. So starting on the 15-minute time frame. Now, what the market has been doing Monday and Tuesday has simply been trading higher, and I'm viewing this as them pumping the market into a premium before CPI data, because on the higher time frame, if we go to the daily chart, we have, ignore this large up close candle. I didn't see any of that coming, but that'll have to change my analysis going into tomorrow. But going into today, I was expecting lower prices because all this price action right here indicated that we potentially turned the corner. We could maybe explore down here. So ultimately, this is what we're kind of aiming for. All these reference points up in here. Was not expecting this at all. Honestly, I wasn't even expecting price to trade to Friday's high, but I was still able to frame a sell scenario that was good for over 100 handles, so it's perfect. So going back down to the 15-minute time frame, we're pumping higher into a premium Monday, Tuesday, and I view this as just them pricing in an expensive premium, engineering buy-side liquidity before they just tank this thing lower and then distribute lower throughout the rest of the week. So I saw exactly what I wanted to see at the high of day today, and that's where I saw my trade model. And I was anticipating us distributing lower throughout the remainder of the week, Thursday and Friday, but obviously it did this. But anyways, it's literally exactly what I outlined on my Notion page. It's perfect. So we have our CPI data at 8:30, and initially the market trades lower, runs this pool of sell-side liquidity, but look what it leaves in its wake. Now it forms these relative equal lows, and this becomes primary sell-side liquidity, and it trades higher and runs buy-side liquidity, right? Going into the 9:30 open. 9:30 open, we immediately drop down, start displacing lower, because we're reaching into this pool of buy-side liquidity, which is also above the previous day high. I had that level on here, but I guess I removed it. But this reversal can be framed off of the previous day high, and we can literally take it to the other side of the range and target the previous day low. So yesterday was Tuesday. We can frame a reversal off the Tuesday's high, targeting Tuesday's low. But this whole run right here, I viewed this as the market just getting excited, reaching a very, very expensive premium, and I was not looking to long the market. I wrote that down in my journal. I said this is way too expensive for me to buy up here. It's trading up into all of these higher time frame premium arrays, and I'm not looking to be long here. I'm looking for a sell scenario, and it gave me exactly that. So if we zoom in, we can see that the bodies of the candles are respecting the 15-minute sell side imbalance, buy side inefficiency, consequent encroachment. So half of that gap, look what the bodies do. Now we wick outside of it, that's permissible. That is just a mohawk. We have to allow and permit coloring outside the lines, but look what the bodies tell you. The bodies are closing below consequent encroachment. So what does that tell us? That tells us the narrative. And if the bodies are closing in the lower half of the 15-minute SIBI, then that is indicative of weakness. And if we look even closer, what does the market wick into? It wicks into this daily volume imbalance and a new day opening gap. So price is not able to traverse either the new day opening gap or daily volume imbalance, and then we see the 15-minute closes below consequent encroachment of that sell side imbalance, buy side inefficiency. So the bodies are clearly indicating that this thing wants to go lower. And since we took out the primary buy side liquidity first above the previous day high, now I'm anticipating that we can take this thing to the other side of the range and target these relative equal lows. And it delivers beautifully. So down to the 5-minute. 9:30 opens. We open in a very expensive premium gap opening because if we look at the difference between yesterday's settlement price, which is where we close at 4:15, and where we open today at 9:30, here's where we closed yesterday at 4:15, here's where we opened. So we have a premium open because we are gapping up. We gapped up between the difference between yesterday's settlement and today's 9:30 open. So price opens in a very high, oh, there it is. There's Tuesday daily over here. So price opens in an expensive premium. And even on the 5-minute, look what the bodies tell you. The bodies are closing below in the lower half of this daily volume imbalance. So if I drop my midline on it, let's see. Look how the bodies stop literally at consequent encroachment of that daily volume imbalance. So that tells me the narrative right now. Narrative right there, clearly, this thing wants to go lower. So at 9:30, the first thing that we see is this large down close candle. And I see this consecutive series of up close candles, and I'm thinking if we can violate the open price of this, this could potentially become an order block. So as soon as I see this large down close candle close, we close below the open price of this, that makes this a bearish order block, and we inverse this 5-minute buy side imbalance, sell side inefficiency. So now we have an inversion fair value gap on the 5-minute time frame. Now there's also some convergence with another PD array in this 5-minute inversion fair value gap. We have the consequent encroachment of the opening range gap. So these two levels lining up in one area, and once we trade down out of the 15-minute SIBI, I don't want to see price return back up to it because it's already done the work there. I wouldn't want to see it return. I'd want to see it act like rocket fuel and immediately send price lower, start propelling price lower towards these relative equal lows. And that's the exact reaction that we get. So I'm not expecting the market to trade back up into this imbalance right here. I want to see that stay open because if the market can't even reprice to that, that indicates that the market is heavy, it is weak, and is going to aggressively seek the sell side liquidity below the marketplace. It's saying, nah, I'm not going to trade up there. I'm not going to reprice to that. I'm on a mission to go hunt out the sell stops down here. So that's exactly what it's telling me when we leave this imbalance. Plus, I wouldn't want to see it traded up to because we've already done the work inside the higher time frame imbalance. I don't want to see it return there. So all this is occurring above the previous day high, inside of this 15-minute imbalance, rejecting the daily volume imbalance, rejecting the new day opening gap. I have a change in the state of delivery. I have an inversion fair value gap. That's basically checks all the significant boxes that I need to see for me to have a trade model or an entry model present in the marketplace. And then if I go to the 1-minute time frame, oh, forgot to mention that this last down close candle before the turn is what? A bearish breaker. So this is my breaker formation, exactly as I outlined on that little drawing that I showed. If I go to a 1-minute, Here's what we do just before the bell. Just before the bell, look at where the bodies stop. Look at us coloring inside that daily volume imbalance. We wick outside of it. That is permissible. You have to allow the market to color outside the lines. The algorithm is going to color outside the lines, but look where the bodies close. They're closing inside of it. So what does that tell you? It is weak. It is heavy. And then once we leave it, look how we trade back up into it, and we wick into it, and then what is that followed by? A large down close candle, violating the open price of this up close candle, this one, and this one. So here, what else do I have? A breaker formation. On the higher time frame, we see the breaker. On the lower time frame, we see the breaker. So those two time frames are green. That tells me I have a quality trade. So we have a high, a low, a higher high, and a lower low. So the last down close candle in the turn before the stop run is my breaker. So that would be right here, right? So this would be my bearish breaker, and look how we kind of accumulate and hang around in it a bit. So it's giving smart money a chance to sell short in the bearish breaker. Look what we also have. We have an inversion fair value gap. It's exactly what I want to see. We have a change in the state of delivery, violating all these up close candles. So these up close candles should act as an order block and hold price down. And here's where I anticipated that change in the state of delivery on the 5-minute time frame. I saw that series of up close candles, and I'm thinking, okay, if we close below this, that would validate that as a bearish order block, and we could potentially see price trade up into that and reject it, although we never did. Look how the bodies of the candles respect the open price of that order block that it never traded up to. So before it was even confirmed as a bearish order block, look what the bodies are doing. So as soon as we cross the open price, we don't even have to close below it. We just have to cross it. And as soon as we cross it, that indicates a change in the state of delivery. So as soon as we cross that open price, look what the bodies do. And that's how we can anticipate an order block forming before it even forms, or before the candle even closes past the open price. This is how we can anticipate an order block forming. Look at that. So if we cross it here, we trade back up into it, and look where the bodies stop. That's perfect. So this is checking all the boxes. I have a breaker, I have an inversion fair value gap, a sell side imbalance, we have a change in the state of delivery. What else? Let me pull up the little drawing. It's everything, right? Except I didn't see an SMT. An SMT is not necessary. I don't have to see an SMT, but if I do see that, that just adds more confidence to the trade. So inversion fair value gap, sell side imbalance, bearish breaker, and a change in the state delivery. And I have all three of those. And this is all occurring above previous day high, trading into this buy side liquidity pool. So it's perfect. It's everything that I need to see. So I see this reaction off the inversion fair value gap right here, and this is exactly how you'd want to see an inversion fair value gap react if it is to be a valid inversion fair value gap. We want to see it wick up into it, close outside of it, and then immediately send price lower after that. It acts like rocket fuel. And that's exactly what it does. So we trade up into it, we close below it, look at the next candle. Next candle, boom, huge down close candle, and that leaves the first presented fair value gap. So I see this information, and in the moment I was thinking maybe this is a possible short, but I need more information. I wasn't so confident in taking the market short on a rally back up into this inversion fair value gap. I wanted to wait for more intel, and I got that, and all the stars were aligning, everything came together, it was perfect. And I had, after seeing all this information up here, and I see the first presented fair value gap, I wrote down, okay, now I want to see the market trade back up into first presented fair value gap, and then roll over and make its way down to the 830 low. So my hypothetical sell was back up into the first presented fair value gap, and notice how the bodies of the candles close in the lower half of that sell side imbalance. So that's exactly what you want to see. That indicates weakness. And like how when we revisit it, we don't even close inside it at all. We just wake up into it and we close below. So this tells me that even though we have this large up close candle, I don't have to worry, because look where the bodies are closing. That tells me the story. That tells me the narrative. And if you look at the open price of this order block, what is it doing? It's holding price down. If we just draw this out in time, we never even touched the mean threshold of this order block. So if we can't even trade up to the mean threshold of the order block, what does that indicate? Oh, we do. We know it would be this range right here. So we fail to reach mean threshold, right? And if we can't even trade up to mean threshold, that's more weakness. That indicates more weakness. So this is where that 5-minute inversion fair value gap is. This is where we have a first presented fair value gap. This is where we have the consequent encroachment of the opening range gap. We have an order block. Everything. It's everything that I need to see. It's perfect. And all this can be framed off of the logic that we're seeing inside of that 15-minute imbalance and the daily volume imbalance and the new day opening gap. Knowing that all this was just the market getting excited and pumping it to a very expensive premium. And the whole time I'm thinking down here. So when the market's up here, I'm thinking down here. So that was a beautiful trade scenario. Literally the model that I drew the previous day, and it delivered for 137 handles. So if we can deliver to this low, what's stopping us from delivering to this low? Absolutely nothing. And look how, boom, liquidity vacuum. So all the longs below this low are not allowed to pull their positions off in time. It literally just sucks all that liquidity out of the marketplace. It attacks it, literally accelerates into it. Speed, distance, magnitude, everything you want to see. So what are we doing here? This is simply the market coming close to that low, priming that low, forming more relative equal lows. These are relatively equal. This is relatively equal as well. So in my eyes, all these up close candles, all these small little retracements, this was just the market engineering more sell side liquidity, because when we come down to the 830 low and we start to turn away from that, well, that's going to make retail traders think that a bottom is in and this is an area of support, and they're going to go long off of that, and they're going to place their sell stops below these lows. So when the market trades back down into the vicinity of this low and begins to turn away, I just view that as them engineering more sell side liquidity. It's just priming that low. Priming that low basically means it's engineering liquidity. And that's exactly what it does. See how it forms relative equal lows, begins to turn away. So when price trades back down to this area, retail is probably like, oh, it could be a bottom in. Let's get this thing long because, you know, look what we saw earlier. We saw this entire move off of this price point. So when we come back down here, we begin to move off of it again. Simple retail logic, thanks support, and let's get long off this level with the stop loss below here. So that is just priming it, engineering more liquidity, and we trade higher. We never violate this order block right here. We reject the mean threshold of the order block perfectly, and look how we, boom, just roll over after that. So after priming the low, look how we just accelerate right through all of that liquidity. It's crazy. Beautiful. This is exactly how you would want to see the algorithm attack a pool of liquidity if you were to expect continuation through that. And another thing, how we can be very confident in the market turning here, I will admit that I literally learned this today. I didn't know this in real time, but ICT taught this on his live stream today. If we trade down to the consequent encroachment of a wick, and we begin building candles around consequent encroachment, we can be very certain that the market is going to take that low out. And that's exactly what happened. He literally said it before it happened, and then it just, boom, like a vacuum, sucked up all that liquidity. Crazy shit. So we trade down the consequent encroachment. We start building these candles, right? We hang around a bit. We spend time down here. It's not the reaction you want to see. You'd want to see it immediately react off of a wick. You don't want to see it hang around like this, but it hangs around. So when the market does this, we can add on to our position with any trade back up into a premium array. So any short-term retracement into a premium array, that's an opportunity to add on to the position. And you can see we trade up into this imbalance here. We trade up to consequent encroachment of this wick, so we can add on here or here. And then boom, it just rolls over. Pretty crazy. So he says that is like a chef's kiss. That is, there's not many things that we can be certain about in trading, but this is one of them. When the market builds candles around consequent encroachment of that wick, that we can be certain that it is going to take that low. And that's exactly what we see here. Beautiful delivery. So, I mean, it was a good feeling seeing that model that I outlined. This is what I look for post 9:30, and it happens. Great feeling. And I also learned a lot about myself today. So, or not about myself, I learned about my progression. So last week, I noticed I was feeling a lot of anxiety, a lot of emotions. Recording these observations and price action I'm not taking any trades right now. I'm just focusing on mastering reading price action and building a trade model before I even start demo trading. So I'm literally just saying I would get short here, and then I just write that down. But last week I noticed that I was feeling a lot of anxiety before doing this. So I'm like, why am I feeling emotions if I'm not even taking any trades? There's nothing on the line. There has to be something going on here. And I realized that I was so worried about being correct in my observations. I wanted to be right because right off the bat, I started with a hypothetical 50% win rate in my observations. And so the more and more that I got observations wrong, and that slowly started to drop below a 50% win rate, subconsciously I viewed that as a lack of progression, and I saw myself as moving backwards each time that I took a hypothetical loss. So that did not sit well with me, and so I would go into making my observations trying to avoid being wrong in them, and that gave me emotions. Anytime I would go to make my observation, I would feel anxiety because I didn't want to be wrong, because if I were to be wrong, I would view that as a lack of progression. And I missed the entire point of this process. The entire point of this process is to put myself in a perfect, harmless environment where I can make as many mistakes as I want, as many mistakes as I can, to learn all about the market and all about myself. So it's ironic because I was trying to prevent myself from being wrong. When I dropped that and realized the whole intention of this process, I actually now want to be wrong. I want to be wrong now, because all your lessons, your best lessons, come from your losing trades. That's where all your greatest lessons are derived from. That's where you get crazy insights into yourself and about the market. So it's ironic because the more observations I started getting wrong, the better I became at reading price action. When really I was trying to protect myself from being wrong. I wasn't progressing as much as I was when I got it wrong more, if that makes sense. So if I just pull up my Notion page, it's already here. So if I go to my weekly statistical progression, see, in the first week, I got just under 50% win rate, right? In the second week, I got slightly over a 50% win rate. And in the week 3, that dropped below 50%. And it was frustrating. I didn't really have a good read on price action. And I started to feel my ego being hurt a bit because I thought, oh man, I'm dropping back below a 50% win rate. I'm not getting better. I'm not progressing. Really, I was. Now, if I go to this week and I see how many observations I got incorrect, I have 6 incorrect observations, and I only have 2 correct observations. But I've become a way better trader this week, and I've gotten way more observations wrong than correct, which is ironic because really you would think that if you get more right, then that shows you are getting better and you're progressing. But the opposite is true in this case. The more that I get wrong, the more I'm able to reflect on what went wrong and extract a lesson from it, and that improves my ability to read price. And so through studying all my incorrect observations, I've been able to build literally the model that I outlined here and that I saw play out in price action today. So it's pretty ironic. The more you lose, the more you get it wrong, the better you are going to be. And that's just the truth about trading. So you have to welcome adversity. You have to, in essence, you have to seek failure. In the beginning, at least. In the beginning, you want to fail. You want to get it wrong as many times as you possibly can, but you have to position yourself to be able to get it wrong as many times as you can, which is why I'm not taking any trades right now, which is why the process that I'm going through right now is absolutely genius, because I'm perfectly positioned to just get it wrong as many times as I can, and it feels good. So I've been going through a lot of mental maturity recently in my trading journey, because I realized that about myself, how I was feeling emotions without even placing any trades. I missed the whole intention of this process. And so now I actually seek getting things wrong, because when I get it wrong, I study what went wrong, I extract the lesson, and I become better. So I've had 6 incorrect observations, 2 right observations, and I'm getting better. So That's it for this one.